If you can't afford to protect someone else's money, you shouldn't have access to that person's money, period. It's simple. If you've been following Phantom for a while, or following the Canadian news cycle, or not absolutely living under a rock when it comes to Canadian regulation, you would be vaguely, if not hyper aware of the Retail Payment Activities Act and how it was ushering in a new era of regulation in Canada, and that regulation being more in line with global regulation around payment companies, around the way that users interact with the intermediary between a bank, which they might not have an appetite to take this retail business. They might have an outdated tech stack. There's any number of reasons that banks enable a middle layer, which is a payment layer, to facilitate the movement of money with retail users. Banks don't necessarily want to do e-wallet payments. They don't necessarily want to service every e-commerce merchant. They don't necessarily want to develop a new API every 2 weeks, but consumers expect these feature-rich systems that dictate to them and, race to the bottom to earn their money, their trust, and their custom. So the RPAA promised to modernize Canada and bring Canada to an illusion, or maybe even a reality of parity with European systems and the frameworks governing electronic money institutions or other payment licenses in Europe and around the world. So I guess the promise was, hey, we're going to bring regulation to this previously underregulated market, this underregulated sector that touches people's money, that exposes people to bankruptcy and insolvency risk. And, as part of our everyday life, every time you buy a pack of gum, every time you fill up your gas tank, every time you do anything that requires any money, unless you're completely living off grid with a solar farm supporting you, you're interacting with these payment companies all the time. You're doing retail payments. Your funds are sitting out there somewhere with some risk of loss. So the deadline for expecting approvals, expecting decisions, expecting some kind of traction and movement from the Bank of Canada that they communicated to everyone for the history of this legislation was September 8th, just 3 days ago, 72 hours ago, whatever unit of measure you want to size it as. And what we've seen is that I don't think there's been a single company achieve an approval yet. There's been a greater degree of detail around the status of these applications, whether they're being reviewed by the Bank of Canada, whether they're being reviewed by Fintech, whether they're being, I don't know if every participant, every registrant, every applicant knew the Department of Finance was going to renew them as part of the process. But here we are, there's hundreds, if not over 1,000 of these sitting at Department of Finance review with a decision pending. And in terms of benefit or detractor, it's just chaos and confusion for the applicants. And you have service providers around the world saying, hey, we were expecting to see you either approved or declined on this list on Monday. Are you compliant? Why aren't you registered? What's going on over there? And how can you account for it? And how can we trust you to continue running a payment company, to continue to have access to client funds, and continue to operate in a compliant fashion if your regulator hasn't decided what to do with you? We're not there yet. And I think it's in market response. And I think it's hey, there's actually no benefit whatsoever. There's no unexpected win. Everybody is just in absolute chaos. As firms, respond to the lack of traction, the lack of action, the lack of published decisions as a result of this application and registration process that has now been going for 10 plus months. I was looking through the registry of applicants, the list of PSP applicants earlier today, because I've been monitoring this website every day, every hour since Monday. And again, there hasn't been a decision made on any of these applicants. And there was a statement published on Monday that said, okay, 1,500 applicants came into supervision on Monday. When you think about how did regulated firms react in the first 6 months, I was clicking through the list of applicants and I got to page 15 of 60 before I saw anyone that hadn't applied on November 1st, which was the first day to pre-register. So I think there's kind of two classes of applicant and two classes of firm. There's people that were, maybe there's three. I'll do three. There's, people that were a going concern that already had a functioning operation, that were aware of the deadline, had a good compliance team internally or externally, and, already had a risk management program, already had safeguarding of funds, already had multiple bank accounts. We get it. We're going to register today. It's no big deal. There's a second bucket of people that were like, we maybe wasted time with a lawyer. We maybe thought we weren't, eligible. We maybe thought we were out of scope. We then realized it's better to be conservative, better to register, better to be safe. We registered later, but we still registered early enough that we got on the list. There's a decision pending and we continue to operate. And then there's a third class of people that are impacted by this double bind of regulatory backlog, where they've done a money services business registration with Fintech or purchased an active trading Canadian company and submitted this registration maybe late, and now they're pending decision from two regulators. They've invested funds, but they can't do anything because maybe the Fintech update hasn't been completed and nobody thinks that they're a compliant money services business. And to add on to that, their decision at the Bank of Canada level hasn't been completed. So it's really hard to walk into any room with any bank, with any risk averse partner and say, hey, please trust me. I did both of these things and I can't prove it. So I think regulated firms reacted in the way you would expect them to. They were aware of this legislation and they complied with it. In terms of how the market's reacting, in terms of how investment capital may or may not be flowing in and out of Canada, I think there's other headwinds present that might be throttling investment in neobanks and fintechs in Canada, like uncertainty regarding stable coins, the backlog of items and issues that is currently at Fintech. So I think it's difficult to be a challenger in Canada for a number of reasons. And this is piling on to that. In terms of who benefits, who gets burned by these delays, certainly it's better if you had a functioning operation that had all these trappings, had a compliance program, had everything, and you did the registration really early. Because at that time, you can just continue to operate and you likely had a compliant money services business in your name on the registry at the time you registered with the Bank of Canada. To say that somebody is a laggard and got burned, I think is unfair, because for me, all of our clients want to do the right thing. All of our clients want to register. All of our clients want to be compliant. It's just that they're now in a scenario where their partners, their banks, the rest of their network says, we're expecting you to have clear guidance from your regulator, and they can't show that they do. I don't think that these scenarios benefit anyone. There's no hidden wins. There's no benefit in here. It's just we're all waiting to see what this decision means, what it means for our global infrastructure, and how we respond. And if you're a cash-strapped or overhead-conscious entrepreneur or startup founder, you're not necessarily going to invest more in your licensing infrastructure, and you're not going to invest more in your Canadian presence if all you're getting is we thank you for your patience. There's a perception that the Retail Payment Activities Act is burdensome, that it's onerous, that it's difficult for businesses to comply with, and that it's ushering in all these new things to Canada that weren't previously there. And if you were to take it from a purely myopic view, all those things would be true. But I don't think that it's simplified processes for any operators or complicated them, because the majority of Phantom's clients already have a global presence. They're not Canada-only businesses, and Fintech isn't the only regulator that they're familiar with. And for me personally, I think I was part of my first electronic money application and approval in like my mid-20s, which is now, 20 years ago. So when these guidelines came in, like, oh, if you have access to your client's money, you should put it in a safe account that doesn't include your credit card spending, your rent, and your whatever. It was like, not only is this incredibly logical as a risk management control, like, just forget any question of whether it's hard to comply with or not. It makes total sense. If I have someone else's money and they're counting on me to keep it safe, I don't put it in the same pocket as my money. Because I'm forgetful, I spend my money, oops, I forgot I spent some of their money, I'll put it back, or I run out of money and I take their money. You can see the scenarios, right? Like the fraud triangle, one of the angles is opportunity. So if the funds are in a separate account, you're breaking the fraud triangle. If there's no opportunity to steal, it's less likely that people will steal. This isn't a question about burden. This isn't a question about sensibility or logic. This is a question about, is industry mature enough to do these things? Does it have the horsepower and does it have the budget to get these things done? Because getting a safeguarding account comes with additional overheads. Getting a safeguarding account that is in Canada, that meets the Bank of Canada's requirements, probably requires you to have a local presence. That requires you to have a local director, a local office, rent, insurance. Of course, that's what I have to do. But for these lean startups that are digital nomad first, that are using hot desks with no utilities in their name, with no insurance, with no real infrastructure, this stuff could be pretty burdensome, not only because it's new for you or because you came to Canada because you didn't have to do it before, but it's also burdensome because you now need an experienced person to evaluate your flow of funds and say, hey, this is where you have custody. This is where funds are at rest. This is what at rest means, by the way. This is where funds are at rest for 48 hours. And this is what you have to do with it. And it's non-negotiable. And you're going to get fined far more than the increased overheads if you get caught jumping bad and doing something wrong. So operational costs likely increased for people that had none of this in place, had no safeguarding procedure, never did a business continuity disaster recovery exercise, never mapped their flow of funds, maybe never even understood their flow of funds, don't even know what trading as principal or trading as agent means. So definitely operational costs rise for people that don't understand or were trying to avoid complying with legislation like this. But for businesses of reasonable size, they're just sort of like, yeah, we already did all that stuff. And in terms of like whether or not this is enforced yet, I don't think we know. So I am aware that a few applications out of the 1,500 PSPs under supervision did get referred to enforcement for either not complying with information requests in a timely fashion, which is normal. You've heard me talk about the importance of complying with requests for information from your regulator or your bank in a timely fashion. It's one of the most important things in compliance. It's how you live and die. But I don't know if we know what the enforcement appetite will be, what the dictators of administrative monetary penalties will be, and how it will be enforced. My feeling is, because the world of compliance and because Canada also loves a risk-based approach, I would guess that applicants that represent a higher risk for things like foreign ownership, thin local structure, opaque flows of funds, poorly structured flows of funds, and legal opinions about why they don't need safeguarding and custody, these things would be where I would place my attention first if I was the regulator. But we just don't know. I think as a last thing on enforcement being fragmented or direct, we do know that the Bank of Canada is following in the footsteps of FinTech and saying, hey, if you're a reporting entity, if you're regulated by us, we will assess you ongoing fees for the cost of regulating you. So you're essentially paying us to regulate you, which, I mean, governments of the world are cash strapped. If you can't, add fees and taxes, how are you going to get more money? So that's unsurprising too. I mean, anybody that wants to get up in arms about the government looking like a government and about regulation looking like regulation is either not paying attention or has a flawed understanding of the world. The key risks that RPAA, I guess, targeted, the key risks that most regulation targets, is risks to consumers and risks to consumer finance posited by rogue actors, bad actors saying, okay, oops, we ran out of money, we stole all your money and we disappeared. Oops, we got hacked and all your money's gone and we're sorry about it. Oops, we got hacked, your personal information got stolen and somebody went and got a loan and bought a boat in your name and the debt's yours and we're out of here. So the key risk that I think all regulation of this nature drives at is forcing bad actors that already don't have money and thus have no business accessing, storing, and managing other people's money. This is, I think, the ostensible purpose of all finance regulation. So I don't know if we've seen this reduce these risks yet, because it's only technically been enforced for 3 days. And that enforce looks like we're not even sure who's approved, who's declined, what a good application looks like, what a bad application looks like. None of these benchmarks are out there. But to get firms started on thinking about this and to get firms started on saying, okay, do I actually have custody of customer money at any time? If I do, how am I storing it and how am I accounting for it? If I'm not storing it in a safe way or accounting for it appropriately, what can I do to improve that? So I think in terms of starting the conversation and in terms of putting a barrier to entry of a monetary fee paid to the Bank of Canada in order to register, and the time it takes to answer all the questions about your business model and the way money moves through your business, tends to eliminate the ability for these bad actors to function, because presumably if you're not on that list, then consumers will be less likely to deal with you. Banks will be less likely to provide you with service because you can't prove that you're compliant and have done these steps. So I think that's kind of the fundamental thing that a regulation like this accomplishes. If you can't afford to protect someone else's money, you shouldn't have access to that person's money. Period. It's simple. But in terms of any other risks beyond that, I don't think we know. And I think firms are, and we've talked about this many, many times, you have your stressed out chief compliance officer that's also responsible for privacy, business continuity. They have some aspect of responsibility if their data breach occurs and so on. I don't think that adding more stuff for these people to do tends to reduce risks. I think it actually increases blind spots and gaps, because the way that budgets work in businesses is you don't allocate resources to risk. You allocate resources to sales, business development, and, technical development of new products that make money. So I don't know if giving people that already have too much to do more stuff to do is effective. And I don't know if making firms eligible for enforcement based on things that don't have enough attention already is effective. And in terms of risks remaining unaddressed, we've talked about regulatory arbitrage, and that being that businesses will tend to migrate to jurisdictions that have a lower regulatory burden, a lower barrier to entry. And we've already seen that. We've seen multiple clients going to other jurisdictions that are just launching a crypto license, that are launching a crypto license that has no provisions around custody, that are launching a crypto license, but their financial intelligence unit cannot yet receive regulatory reports, right? And these aren't necessarily bad actors. These are just people that do business with a very select subset of clients that don't care about retail payment safety because their trades are never custodial. They're all transactional. They're accessing, spot FX swaps on an ongoing basis through niche banks that have nothing to do with Canada's national economy or regulations. So I think regulatory arbitrage will always exist. There will always be terra nullius. There will always be the frontier spirit that wants to discover it. But that's not the spirit of the Retail Payment Activities Act. That's the spirit of it, is to protect retail payments and to protect retail consumers. So, saying that regulatory arbitrage is part of this conversation is flawed. There's a question about whether or not regulation and regulatory bodies fundamentally limit competition in the market, fundamentally limit the free market, make it more restrictive, and so on. And did the RPAA make things more competitive, less competitive? Everything stays the same. I think in terms of Canada, it makes you have to be much more well-funded, and it makes you need more than a couple $1,000s and a dream. So in terms of leveling the playing field, not for a business that has funding that knows what it's doing, it does eliminate the ability for the bottom of the barrel to participate, for the bottom of the barrel to be treated as credible, and for them to access world-class licensing perception without going through the overheads and processes that are present in more mature regulatory markets like Europe. We get clients all the time that think, okay, I don't have $1 million in 2 years right now. I don't have the money for capital adequacy, but I do have a lot of clients. I do have a tech stack. I do have this much revenue a month versus this much burn, so I'm profitable. I need to be licensed in a short period of time while I go after Europe so I can keep doing business. Canada looks attractive, and the cost of RPAA is not prohibitive and still looks attractive. And even for people that are going to unlicensed or under-licensed markets, the cost of a money services business plus an MSB registration plus an RPAA registration is not that much more. In fact, might be less. So I don't know if a conversation about leveling the playing field is relevant. I think maybe making the bottom higher is the most relevant aspect of it. And smaller firms being, I guess, squeezed, I don't think is the right conversation, because quite frankly, and people are always surprised, everybody thinks I'm like this high risk cowboy. I guess, I got Alberta tattooed on my arm, and I do have a farming background, but like, I'm very conservative. I'm very conservative when it comes to my risk appetite. I think you have no right to touch other people's money if you don't already have money, and if you don't already have an understanding of what it takes to be responsible for someone else's money. So I think smaller firms that don't have money and don't have the ability to hang should be squeezed out. If you are a person that would have a likelihood to steal money, you shouldn't have access to other people's money. If you are a person that is running on an incredibly tight budget and, you're not going to be around for 6 months, you shouldn't be part of someone's long-term financial plan. And I guess I'll reserve comment on whether or not VC firms that fund these businesses that have insane monthly overheads and are running at a loss, but are a unicorn, they're this cycle's unicorn, I'll leave that out, because I wouldn't invest in a business that loses money. You know what I mean? But that's not really my decision. Has the RPAA improved market integrity? Absolutely. I think the quality of players that are going to be doing payment services in Canada is necessarily going to increase. But does the Bank of Canada have the enforcement budget and the people to effectively govern their entire sample subset? I don't know, because the staff is necessarily smaller than the number of applicants and registrants. That's how it is. And statistical sampling is always bound to miss something, right? So even if we're enforcing these things on a fair, random basis, something's going to slip through the cracks, and then it's going to become time for the annual report. Some firms aren't going to file the annual report. They're going to get struck off. They might not care. Their bank may never check the registry. There may be a follow-on effect where these bad actors get to keep going. But this happened before this regulation with other regulations. So it would be unfair to say that the RPAA failed simply because it looks like other regulatory efforts that preceded it, right? And it had the same impact and effects and blind spots of other regulatory impacts. I think the current news cycle and current media attention too often expects everything to be error-free. I don't even have an error-free day in my life. I drop my coffee cup, I put my shirt on inside out. All kinds of stuff happens in a day that you can't control, or maybe you could control, but you're busy or something else happens. So I think it's unfair to expect 100% quality and hit rate of this new regulation. And as we're looking forward, what amendments or clarifications are likely? The number one likely that I think is to be amended is the safeguarding requirement. So in the UK, for example, there's 3 ways to meet the safeguarding requirement, and this is incredibly flexible and encourages competition and encourages smaller operators to enter the market, because if you can't get a safeguarding account, you can also produce a daily reconciliation and accounting of all the funds that are your customers and all the funds that are yours. Super fair, right? If you have good internal governance, you track every dollar, there's no shortfalls. And if that shortfall is of a material nature, you investigate and rectify it. Sounds pretty safe to me. If you don't want to do daily reconciliation, you get a private insurer equal to the amount of client funds that you hold. Sounds pretty safe to me. And that insurer is going to have more stringent audit requirements and discovery requirements than your regulator. Last one is the safeguarding account, which we've already all, through consensus reality validated as kind of the best one. You have a separate pocket where your customer's money is. I think this is the most likely amendment or clarification. Firms should be positioning themselves in the same way they position themselves for compliance with other regulation, which is they should be prepared to be audited. The target for any of these businesses should be to be able to be audited and to be able to front up on the questions that are likely to be asked under that legislation, and to be asked to be responded to in an efficient manner. So if you can't tell me how your flow of funds is today, I think you have work to do. And if you can't map out who has custody of client funds as you're moving them from point A to point B, I think you should seriously examine how your business functions. And we get this with clients all the time where they're like, listen, I have all this stuff, just draw me a map. Tell me where your customer information is stored, who has access to it, what your fallback is. And they're like, oh, well, nobody really ever asked that. And it's like, Okay, well, that's fine. Let's work through it together. It's not that big a deal. It's a short sprint to address it. But I think firms should be preparing for this in the same way they prepare for all regulation, is that, the perception of enforcement is the most effective deterrent. And the way for regulators to make sure the perception of enforcement is high is to enforce it through audits and administrative monetary penalties. So, all of this stuff is written down. All of this stuff is public information. If firms can't read, process information, and enact what they read, we are unable to help them. But if they're literate and proactive, I think they have a good chance of survival.